Your savings account is being quietly destroyed, and most people won't realize it until it's too late. While you've been told that keeping your money in the bank is the safe, responsible thing to do, something fundamental has shifted in the financial system. The rules have changed, and the people who understand what's happening are moving their wealth into physical assets at a pace we haven't seen in decades. Let me show you what's really going on. Right now, silver is trading near historic highs, and gold has broken through resistance levels that analysts said were impossible just months ago. But this isn't just another bull market rally. This is something different. This is the market telling us that the foundation of our monetary system is cracking, and the smart money is racing to get out before the general public catches on. Think about what's happened to your purchasing power over the last few years. That grocery bill that used to be manageable, it's doubled. The gas you put in your car, up significantly. Your insurance premiums, your utility bills, everything costs more. But here's what they're not telling you. Your savings account is earning maybe 1 or 2% interest while real inflation is running much, much higher. You're not saving money. You're watching it evaporate in slow motion. The Federal Reserve will tell you inflation is under control. They'll point to their carefully selected statistics and assure you everything is fine. But walk into any grocery store, any hardware store, any restaurant, and ask yourself if their numbers match your reality. They don't, because they're measuring the wrong things. Or more accurately, they're measuring things in a way that hides the truth. Now here's where it gets interesting. While regular Americans are being told to keep their money in savings accounts earning next to nothing, central banks around the world are buying gold at the fastest pace in history. Not paper gold, not gold ETFs, physical gold bars that they're storing in their vaults. Why would central banks, the very institutions that print money and control monetary policy, be converting their reserves into gold if everything was fine with the currency system? Let me paint you a picture of what's happening behind the scenes. In the last year alone, central banks added over 1,000 tons of gold to their reserves. That's not a small number. That's not a hedge. That's a wholesale shift in strategy. These are the people who have access to information you and I will never see. They sit in meetings where the real economic data is discussed, where the actual risks to the financial system are laid out on the table, and they're buying gold like there's no tomorrow. But it's not just central banks. Look at what the major institutions are doing. Investment firms that manage trillions of dollars are quietly increasing their positions in precious metals. Billionaire investors who built their fortunes by seeing trends before everyone else are moving significant portions of their wealth into physical assets. These aren't conspiracy theorists or doomsday preppers. These are the most sophisticated financial minds in the world, and they're all moving in the same direction. Before we go further, I want to share something with you. I've put together a free guide that breaks down the savings secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's in the description below. No cost, no obligation, just information that could make a real difference in how you think about protecting what you've worked your whole life to build. Grab it while it's still available. Now let's talk about silver specifically, because silver is where this story gets really compelling. Silver isn't just a precious metal. It's an industrial metal that's absolutely critical to modern technology. Every solar panel requires silver. Every electric vehicle uses significantly more silver than a traditional car. 5G infrastructure, medical devices, electronics, water purification systems, they all need silver. And here's the problem. We're using more silver than we're mining. Think about that for a second. Global demand for silver exceeds global supply. That's not a temporary imbalance. That's a structural deficit that's been building for years. The silver that's being used in industrial applications isn't coming back. It's not like gold jewelry that can be melted down and recycled. When silver goes into a solar panel or an electronic circuit board, it's gone. It's consumed. And we're consuming more every single year. The solar industry alone is projected to use massive amounts of silver over the next decade. Every major economy has committed to expanding renewable energy. That means millions of new solar panels, and every single one of them needs silver. The electric vehicle revolution, same story. As the world transitions away from internal combustion engines, the demand for silver in EVs and charging infrastructure is going to explode. But here's where the supply side of the equation gets really interesting. Silver mining is incredibly difficult and expensive. Most silver doesn't come from primary silver mines. It comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal prices drop, or when those mines become unprofitable, silver production drops too. And right now, we're not seeing new major silver deposits being developed. The lead time to bring a new mine online is measured in years, sometimes decades. Even if silver prices double or triple from here, the supply response won't be immediate. Let me tell you about something that happened in the silver market that most people don't know about. Back in the late 70s, silver went from around $5 an ounce to $50 an ounce in a matter of months. It wasn't because of industrial demand. It was because investors realized that silver was dramatically undervalued relative to gold and relative to the money supply. When that realization hit, the price exploded. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying that the fundamentals today are even more compelling than they were back then. Here's what's different now. In the 70s, silver was primarily a monetary metal and an industrial metal. Today, it's become absolutely critical to technologies that didn't even exist back then. The industrial demand floor under silver is much, much higher. At the same time, the amount of money that's been printed, the amount of currency that's been created out of thin air, is orders of magnitude larger than it was in the 70s. So you have stronger industrial demand, tighter supply, and a massively expanded money supply. That's a recipe for a significant repricing. Now let's talk about what's happening in the physical silver market right now. Go try to buy physical silver from a dealer. You'll notice something interesting. The premiums over spot price are high, and in many cases, there are delays in delivery. Why? Because there's a disconnect between the paper silver market and the physical silver market. On the COMEX, the futures exchange where silver is traded, there are massive amounts of paper contracts representing silver. But when people start asking for physical delivery, suddenly there are problems. This is the dirty secret of the precious metals market. The price you see quoted, the spot price, is determined by trading in paper contracts, not by actual physical metal changing hands. It's a system that allows for price suppression because you can create unlimited paper contracts, but you can't create unlimited physical metal. And as more people wake up to this reality and start demanding physical delivery, the system is going to face a reckoning. Think about what happened in the nickel market not too long ago. A major short squeeze forced the London Metal Exchange to literally halt trading and cancel trades because the price moved too far too fast. The people who were short couldn't deliver the physical metal, and the exchange had to step in to prevent a complete meltdown. Now, nickel is important, but it's not nearly as critical or as widely held as silver. What happens when a similar dynamic plays out in the silver market? The commercial banks that are short silver on the COMEX are sitting on positions that would be catastrophic if they had to deliver physical metal at current prices, let alone at prices significantly higher. They're counting on the fact that most contract holders will roll their positions or settle in cash rather than demanding delivery. But what happens when that assumption breaks down? What happens when a significant percentage of contract holders say, "No, I want the actual metal"? We're already seeing signs of stress in the system. The amount of silver in COMEX warehouses has been declining. The premiums for physical silver have been elevated for an extended period. Mints around the world are struggling to keep up with demand for silver coins and bars. These are all symptoms of a market where the paper price and the physical reality are diverging. Now let's zoom out and look at the bigger picture. Why is all of this happening now? What's changed? The answer is that we're living through the end of an era in monetary policy. For decades, the solution to every economic problem has been to print more money, to lower interest rates, to inject more liquidity into the system. And for a while, it worked, or at least it seemed to work. Asset prices went up, the stock market hit new highs, and people felt wealthier. But there's a cost to all of that money printing, and we're starting to pay it now. The cost is inflation, the erosion of purchasing power, the destruction of savings. When you create trillions of dollars out of thin air, those dollars have to go somewhere. They flow into assets, they flow into commodities, they flow into anything that can't be printed. And that's exactly what we're seeing. Gold and silver aren't going up because they're becoming more valuable. They're going up because the currency they're priced in is becoming less valuable. It's not that precious metals are expensive. It's that dollars are cheap. And as more dollars are created, as more debt is monetized, as more stimulus is injected into the economy, that dynamic is only going to accelerate. Here's something that should terrify anyone with significant savings in a bank account. The real interest rate, the rate you earn on your savings minus the rate of inflation, is deeply negative. You're being paid 1 or 2% while your purchasing power is declining by much more than that every year. You're not earning a return. You're accepting a guaranteed loss. And the longer you stay in that position, the more wealth you lose. Now, some people will say, but what about the stock market? Stocks have been a great hedge against inflation. And that's true, to a point. But stocks come with risk. Stocks can crash. Stocks are tied to corporate earnings, to economic growth, to factors that are increasingly uncertain in this environment. And when you look at stock valuations relative to historical norms, relative to earnings, relative to GDP, we're in bubble territory. The stock market might keep going up, but it might not. And if you're in or near retirement, can you afford to take that risk? This is where physical precious metals offer something unique. They're not someone else's liability. They're not dependent on a company's performance or a government's promises. They're tangible assets that have held value for thousands of years. When empires have fallen, when currencies have collapsed, when financial systems have imploded, gold and silver have survived. They've more than survived, they've thrived. Let me share something with you that might be relevant to your situation. If you're sitting on $100,000 or more in retirement accounts, there's a strategy that a lot of people don't know about. It's called a gold IRA, and it allows you to hold physical precious metals inside your retirement account without triggering taxes or penalties. I've put together a guide that explains exactly how this works, what the rules are, and how to do it properly. It's in the description below. This isn't about making a quick buck. This is about protecting decades of hard work from the monetary chaos that's unfolding. If that's relevant to your situation, it's worth taking a look. Now back to what's happening in the markets. One of the most telling indicators of where we are in this cycle is the gold to silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere in the range of 50 to 60. When it gets much higher than that, it means silver is cheap relative to gold. When it gets much lower, it means silver is expensive relative to gold. Right now, even with silver's recent gains, the ratio is still elevated compared to historical averages. What does that tell us? It tells us that silver has significant room to run. If silver simply reverts to its historical relationship with gold, we're looking at substantial upside from current levels. And if silver overshoots to the upside, the way it has in previous bull markets, we could see truly explosive moves. But here's what makes this cycle different from previous ones. In past precious metals bull markets, the primary driver was investment demand. People bought gold and silver because they were worried about inflation or currency devaluation. The industrial demand was there, but it was secondary. Today, the industrial demand is the primary driver, and the investment demand is just starting to wake up. When you combine strong industrial fundamentals with increasing investment demand, you get a bull market that has legs, that has staying power. Think about the solar industry for a moment. Governments around the world have committed hundreds of billions of dollars to renewable energy. That's not speculation. That's policy. That's money that's going to be spent regardless of what happens in the broader economy. And every solar panel that gets installed requires silver. The International Energy Agency projects that solar capacity is going to multiply several times over in the coming years. Do the math on how much silver that requires, and then ask yourself where that silver is going to come from. The electric vehicle story is similar. Every major automaker has announced plans to transition their fleets to electric. Some have set deadlines for phasing out internal combustion engines entirely. An electric vehicle uses significantly more silver than a traditional car. As EV adoption accelerates, and it is accelerating, the demand for silver is going to surge. This isn't a maybe. This is a certainty based on trends that are already in motion. Now let's talk about what happens when the investment community fully wakes up to this story. Right now, precious metals represent a tiny fraction of global investment portfolios. Most people have zero exposure to gold or silver. Most financial advisors don't recommend them. Most retirement accounts don't hold them. But that's starting to change. As inflation persists, as currency concerns grow, as geopolitical tensions escalate, more and more investors are going to look for safe havens. And when they do, they're going to discover that the precious metals market is much smaller than they thought. The entire global silver market, all the silver that's mined in a year, is worth less than the market cap of many individual tech companies. If even a small percentage of the money sitting in stocks or bonds or real estate decides to move into silver, the price impact would be enormous. We're talking about a relatively tiny market, trying to absorb potentially massive inflows of capital. The laws of supply and demand are pretty clear about what happens in that scenario. Here's another angle that most people aren't considering. The geopolitical landscape is shifting in ways that favor hard assets over financial assets. The dollar's role as the global reserve currency is being challenged. Countries are settling trade in their own currencies. Central banks are diversifying away from dollar reserves. The BRICS nations are exploring alternatives to the dollar-dominated financial system. None of this happens overnight, but the trend is clear and it's accelerating. What does this mean for you? It means that the assumption that the dollar will always be strong, that it will always be accepted, that it will always hold its value, is no longer a safe assumption. And if the dollar weakens significantly, if its role in the global economy diminishes, the purchasing power of your dollar-denominated savings is going to take a hit. But physical assets, assets that have intrinsic value regardless of what currency they're priced in, those assets are going to hold up much better. Let me tell you about something that happened in the gold market that illustrates this point. When the Soviet Union collapsed, people who had their wealth in rubles saw it evaporate almost overnight. The currency became worthless. But people who had gold, even small amounts of gold, were able to preserve their wealth and even thrive in the chaos that followed. Now, I'm not saying the dollar is going to collapse like the ruble did, but I am saying that currency risk is real, and it's something that every saver needs to think about. The challenge with savings accounts is that they give you the illusion of safety. You see a number on a statement, and that number doesn't change much. It might even go up a little bit with interest. But that number is denominated in a currency that's losing value. So while the number stays the same or grows slightly, what that number can actually buy is declining. You're on a treadmill, running in place while the ground beneath you moves backward. Physical silver, on the other hand, is real. It's tangible. It's an ounce of metal that has industrial uses, that has been valued for millennia, that can't be printed or created out of thin air. When you hold silver, you're holding something that has intrinsic worth independent of any government's promises or any central bank's policies. And in an era where those promises and policies are increasingly questionable, that matters. Now, I want to address something that skeptics often bring up. They'll say, but silver doesn't pay dividends. It doesn't generate income. Why would I hold an asset that just sits there? And that's a fair question. But here's the answer. In an environment where your savings are losing purchasing power every year, preservation of wealth is income. If you can hold an asset that maintains or increases its purchasing power while everything else is declining, you're effectively earning a return. You're protecting what you have, which is the first rule of wealth building. Think about it this way. If you have $100,000 in a savings account earning 2% and inflation is running at 8 or 10%, you're losing $6,000 to $8,000 a year in purchasing power. That's real money. That's wealth destruction happening in slow motion. But if you had that $100,000 in an asset that appreciated with inflation or outpaced it, you'd be preserving your wealth. You'd be maintaining your standard of living. And in times like these, that's worth more than any dividend. The other thing to understand is that we're not talking about putting all your money into silver or gold. We're talking about diversification, about having a portion of your wealth in assets that aren't correlated with the stock market, that aren't dependent on the banking system, that aren't vulnerable to currency devaluation. It's about balance, about not having all your eggs in one basket, especially when that basket is looking increasingly fragile. Let's talk about what could trigger the next major move in silver. There are several potential catalysts on the horizon. One is a supply disruption. If a major silver-producing mine has problems, if there's political instability in a key producing country, if environmental regulations restrict production, the impact on supply could be immediate and significant. And given how tight the supply-demand balance already is, even a small disruption could send prices soaring. Another catalyst is a shift in investment flows. If a major institution, a sovereign wealth fund, a pension fund, decides to allocate even a small percentage of their portfolio to physical silver, the buying pressure would be immense. We've seen this happen in other commodities. When big money moves, it moves fast, and it moves in size. The silver market is small enough that institutional buying could overwhelm available supply very quickly. A third catalyst is a loss of confidence in the financial system. If there's another banking crisis, if there's a sovereign debt default, if there's a currency crisis somewhere in the world, investors are going to flee to safety. And historically, that safety has been found in precious metals. We saw this in 2008. We saw it during the European debt crisis. We're seeing it now as concerns about the banking system resurface. When fear enters the market, gold and silver are where people run. But here's what's different this time. In previous crises, central banks could step in with massive stimulus, with bailouts, with whatever it took to stabilize the system. And it worked, at least temporarily. But now, with inflation already elevated, with debt levels at historic highs, with political pressure mounting, the playbook that worked before might not work this time. The tools that central banks have relied on are becoming less effective, and in some cases, they're making the problem worse. What happens when the next crisis hits and the Fed can't just print unlimited money without triggering runaway inflation? What happens when governments can't bail out failing institutions without destroying their currencies? What happens when the system that's been held together with monetary duct tape finally breaks? The answer is that people are going to look for assets that exist outside that system, assets that don't depend on central bank policies or government promises. And that's where precious metals shine. Now, I want to bring this back to your personal situation. If you're watching this, you're probably someone who's worked hard, who's saved diligently, who's done everything you were told to do to build financial security. You've put money in the bank, you've contributed to your retirement accounts, you've been responsible, and now you're watching the value of that hard work erode because of forces beyond your control. That's not fair, but it's reality. The question is, what are you going to do about it? Are you going to keep doing the same thing and hope for a different result? Are you going to trust that the people who created this mess are going to fix it? Or are you going to take control of your financial future and make decisions based on what's actually happening, not on what you're being told is happening? For thousands of American retirees, the answer has been to diversify into physical precious metals, not as a speculation, not as a get-rich-quick scheme, but as a wealth preservation strategy, as a way to protect what they've spent a lifetime building from the monetary chaos that's unfolding. And the results speak for themselves. While savings accounts have lost purchasing power, while bond portfolios have been decimated, physical gold and silver have held their value and then some. If you've made it this far in the video, you're clearly someone who takes this seriously, someone who's willing to look at uncomfortable truths and make informed decisions. And I want to reward that. For people who've watched to the end, I'm offering something special. In the description below, there's information about a one-on-one educational web conference. No sales pitch, no obligation, just a conversation about your specific situation and how precious metals might fit into your overall strategy. This is only available to American retirees with at least $100,000 in retirement accounts, and you have to mention that you watched this video to qualify. It's completely free, and it could be the most valuable hour you spend this year. Here's the bottom line. Your savings account is not safe. The purchasing power of your dollars is being eroded by inflation that's running much higher than official statistics suggest. The institutions that are supposed to protect your wealth, the banks, the government, the Federal Reserve, are the same institutions that created this problem. And they're not going to fix it because fixing it would require admitting they were wrong, would require making painful choices that are politically unpopular. Meanwhile, the smart money, the central banks, the billionaires, the institutions with access to the best information and the best advisors are moving into hard assets. They're buying gold and silver at a pace we haven't seen in generations. They're not doing this because they're panicking. They're doing it because they understand what's coming. They see the writing on the wall and they're positioning themselves accordingly. The question is, are you going to wait until everyone else figures it out? Until the price of silver has already multiplied? Until physical metal is hard to find at any price? Or are you going to act now while you still can, while the opportunity is still available? The choice is yours, but the window is closing. The forces that are driving this market are accelerating, not slowing down. And once the general public catches on, once the rush for physical metal really begins, it's going to be too late to get in at reasonable prices. This isn't about fear. This isn't about doom and gloom. This is about being realistic, about looking at the facts, about understanding the environment we're in, and making rational decisions based on that understanding. Your savings account might feel safe because it's familiar, because it's what you've always done. But safety is an illusion when the currency your savings are denominated in is losing value every single day. Silver offers something different. It offers real value, tangible wealth, an asset that's been recognized as money for thousands of years and is now more critical to modern industry than ever before. It offers protection from currency devaluation, from inflation, from the monetary experiments that are destroying the purchasing power of savers around the world, and it offers upside potential that few other assets can match given the supply-demand fundamentals we're seeing.